Morning, everybody, and welcome to this WHEB's Q4 update webinar, which will also be a chance for us to talk about the announcement we made last week for WHEB Asset Management to be acquired by Foresight Group. So welcome to everybody, my name is George Latham. I'm the managing partner at WHEB Asset Management. I'm going to be joined on the call today by both Ted Franks, partner and fund manager at WHEB, and also Seb Beloe, my other partner and the head of research. So just to start off with, as always, we'll just start with the obligatory disclaimer. Just to make clear, we have clients here from both the UK and also across Europe. So we'll be talking what we're talking about is relevant to the strategies and the funds that we run across WHEB. And so you're all very welcome here on this call. Just a couple of moments of housekeeping. We expect to be speaking for about 40 minutes this morning. We'll leave some time therefore for 20 minutes or so for Q&A, and we expect to be finished by 11 o'clock. If you have any technical issues, then please do use the chat function and we'll try and help, or otherwise do email me on george.latham@webgroup.com. And there's a Q&A function on Zoom, which I'm sure you're all used to using. So please use that to ask questions throughout the webinar, and we'll pick them up and then we'll use them in the Q&A at the end. Any we can't answer or don't have time to answer during this next hour, we'll try and follow up by email and come back to you as soon as we can after this event. This webinar is being recorded, and we will send a link out to the recording after the event, as well as a copy of the slides to anyone who wants to have them. And as usual, we'll also post it on our website. So without further ado, just to move on to the agenda, I'm going to start off by giving some insights and hopefully a description of what we announced last week about WHEB joining Foresight Group. We will then continue with our standard quarterly review of the strategy and the outlook. And Seb is going to come on and talk a bit further about developments in our climate adaptation theme as we move through as well. So just by way of start off, we are very excited to have announced last week. I'm sure most of you will have seen the announcement by Foresight that they are acquiring the business and assets of WHEB Asset Management. We made that announcement last Tuesday. And so this is a significant event, obviously, in our history. And puts us in a very significant platform going forward to develop WHEB and to enable us to achieve our full potential as a business and for the mission and philosophy that we've set out over the years. So just to give people a little bit of a background, I'm sure many of you have heard of Foresight before. Many of you will be familiar with their products and their investment strategies. But for those of you who are not, then Foresight has a very long track record and a very long history of investing in the energy transition. They originally started in the mid-80s and have built a significant business investing in clean energy infrastructure, in nature recovery and private equity over many decades, and are now a London-listed company with a market capitalization of around 450 million and around 12.4 billion of assets under management. Before WHEB joins, there are already over 150 investment professionals at Foresight, and we have offices both in London, in the Shard, across the UK, and in Europe and Australia as well. There's three divisions in Foresight Group. The original energy infrastructure division, investing in clean energy infrastructure for both retail and institutional investors. A private equity business, which has a significant presence in place-based local impact investing locally for local government pension schemes, in ambitious companies to grow in those local markets and with significant impact in those local areas. And the more recent Foresight Capital Management, investing in listed equities in products that also have that clean energy infrastructure exposure. So from WHEB's perspective, this is a really strong partnership. We've been, WHEB, as you know, is a partnership. Myself and Ted and Seb, significant owners of that partnership, and we've been developing that for the last 12 years with an external investor who is really our angel investor, enabled us to get up to scale over the years, but was a financial investor and had really sort of done their time, if you like, in their support for WHEB. And we've been looking over the last few years and trying to establish what was the ideal type of strategic partner to create a platform for WHEB to really be able to fulfill its potential in the coming decades and longer, to build the business as the strongest possible it could be, to really deliver on our mission, to advance sustainability and create prosperity through positive impact investments. And to do that, we'd set out in our search, as we evaluated potential partners, 4 key criteria that we wanted to evaluate them against, that we wanted to achieve in any combination. And that was firstly and critically to have a focus and an understanding of what impact means and what it means to invest in impact. WHEB's business obviously is built entirely around impact in listed equities. We want to be part of a business that understands impact, understands this type of investing, and has a similar mission and alignment in philosophy in terms of the kind of investments it looks for. Clearly, as I've described, Foresight meets this criteria very, very well, with its long heritage, its long track record of investing in clean energy infrastructure, in place-based local impact investing, and having a business also in listed equities that is complementary to what we do, rather than competitive in any way. And so we slot very well into that structure to be able to create a platform across different asset classes that can really establish a strength around impact and a commonality of proposition as we face off against our clients, and to build our product suite for the future. We also wanted to build resilience into the business. Clearly, as an independent single strategy business with a very differentiated market focus, we are exposed to the market cycles that we see in investments. It has been a difficult market over the last few years, and we wanted investors to have confidence that WHEB is on a platform where it can be resilient through those markets and build and invest in a consistent way, and not be exposed to the vagaries of short-term movements in the market. Foresight is a significantly larger investor with significant balance sheet, significant cash on that balance sheet, ability to present a really resilient and strong outlook for the market and invest for the long term and through cycles. We also want to be in a larger structure, which enables us to access greater institutional investments. As we see the market for impact investing starts to mature and starts to establish, we're seeing more and more institutional investors who are looking to allocate larger amounts of capital, and we want to be on a platform that has the scale to be a credible counterparty for those larger investment mandates that we see coming through. And we think the combination with Foresight really enables us to do that and to give confidence to our partners that they're investing with a scalable sort of investor to work with, and to be working with somebody who has the ability to think countercyclically. And from Foresight's strength in unlisted investments, in private investments, to be investing now in listed equity markets and investing in impact at this point, really shows a mentality and a thought process that is for the longer term and is focused on investing where they see opportunities, rather than with that shorter term mindset. The third criteria we wanted to address and look for and build on is to really build a stronger distribution capability and a stronger ability to manage our client relationships. Foresight Capital Management, which WHEB will become a part of, already has a dedicated sales and distribution team of 4, led by Tom McKillicuddy, who has a really strong presence and background in the impact investing market. And we're delighted to be able to work with them, and so that will increase our reach and our ability to service our clients and look after our clients in a really strong way. And beyond just Foresight Capital Management, we'll also be able to work with the much larger team that's in the wider Foresight group, servicing IFAs and local government pension schemes, institutional and retail investors across Foresight Group's products. And we're looking also for opportunities for growth, to develop, both from a product perspective and to support our team. So the combination, we think, is so unique across impact investing across multiple different asset classes, allows us to build solutions for our clients in a joined up way, also to have the potential to develop new product that's complementary to our existing global equity franchise over the long term. And that will create opportunities for our team, which will enable us to attract and to retain the best talent in impact investing for the longer term. So that's why Foresight made such an ideal partner for WHEB. But although I've talked about things that will improve and build for WHEB in the long term in this combination, it's really important that we place a real emphasis on the importance of continuity. And this transaction allows us to do that. The partners are very much bought into this transaction, will be incentivized through our earnout over 3 years. And so the partners in the investment team will join Foresight Capital Management. Our resources will be unchanged. In fact, they'll be enhanced by the combination of additional, in terms of the additional research we'll see around us. But the investment process will be run autonomously. There's no great sort of combination. There's no great sort of integration to go through, so that we can run the investment process in a consistent and a continuous way without disturbing it going through this combination. Foresight really recognizes the strength we've built in the WHEB brand and what it stands for in terms of authenticity around positive impact, around our transparency, around the way that we interface with our clients, and we build confidence in our clients around our focus on impact investing. And so the WHEB brand and the fund names will remain unchanged going through this process and as we join together with Foresight. So the team and the process is unchanged by the transaction, and so is our approach to transparency and governance. So we'll retain our independent investment advisory committee, we'll retain all the features of transparency that we've talked about over the years, the company profiles that we publish, the reporting that we do around our impact. In fact, that's now embedded anyway through the SDR program and through the requirements of SDR, and so we'll be able to build on that. But it will be unchanged as we go through. So the combination really, we think, can help us to enhance our commitment to impact investing in listed equities and build on the strengths that of the foundations that we've put in place over 12 years to create really the strongest leader in impact investing that we can imagine. So in combination with Foresight and Foresight Capital Management in particular, we will create a unique blend of sustainability and impact investing credentials and capability. Just within Foresight Capital Management, we will have a team of 16 investment and sustainability professionals. That's greater than our existing teams, so building on strength. We will build greater strength and distribution than we have currently, with a combined AUM of over 1.3 billion in that part of the business. As I say, the transaction, we've said publicly, will be expected to close in the first half. That's quite a cautious statement, if you like. We expect to close it in a matter of weeks rather than months, really. And so we expect to move on and to be able to present and build on this unique blend that we expect to be putting together through this transaction. So we're really excited about the combination, really excited about the future of what we can develop through coming together with Foresight, and very pleased to have got to this point where we're able to announce it. And to then get on to building the new strengths that it gives us the opportunity to do. So hopefully that gives you something of an introduction to Foresight and this transaction and where we see ourselves moving from here. But as I said, as much as anything changes, much stays the same. So this is a quarterly webinar, and so we will retain the format here. And I'm going to hand over now to Ted. It'll feel like a bit of a gear change to move on to the strategy review and outlook in the more immediate sense. But we wanted to, many of you will have signed up for this webinar originally to see that. So we want to make sure that we keep that consistency in place. So at that point, I'll stop sharing. We can come back to questions, but I'll hand over to Ted, who can take it from here.
So the review for the fourth quarter of 2024, in terms of strategy performance, it's obviously been a very tricky quarter for impact and sustainability investing, because the new leader of the free world has been elected and is Donald Trump for his second term. It's kind of a point of housekeeping to go through this step by step so that everybody understands what's going on, but it is very much in the news. So apologies if these are things you've already picked up on. Clearly, his new team and agenda administration is a challenge for a lot of sustainability issues. On the slide here, we'll talk through 5 of the sort of key sustainability areas where he's going to have a sort of challenging impact. The following slide, we're going to talk a little bit about some of the areas that he favours and how they might have had a relative benefit. So taking these 5 in order from the left to right, trade, obviously, he's got a lot of views about tariffs and trade and how that should work. We've said many times, the companies we invest in that provide solutions to sustainability challenges are kind of intellectual property-led global exporters. They're definitely into a globalized supply chain. Big disruptions to trade are difficult. They're also difficult just as a sort of philosophical point. If you're a stock picker, what you want is kind of a level playing field. We'll come on to that a little bit later as well. From the sort of very macro trade point down to a kind of very specific point, renewable energy, obviously not popular with Donald Trump, and offshore wind in particular, and offshore wind in the US, looks like it's going into something of a deep freeze. We've got some comments on that later on as well. So that's obviously a challenge for some of the important supply chains in the sustainability industry. In the middle picture here is a Cybertruck. It's an electric vehicle, notwithstanding that it's manufactured by Donald Trump's new very close associate, Elon Musk. It still symbolizes here his lack of support for electric vehicles. That's one of the parts of the flagship Inflation Reduction Act, which it seems as though Trump is going to find easier to undo than the overall piece of the IRA. The 4th picture is a bit about vaccine hesitancy. Now, this is a very important strand of what's happening with the second Trump administration. We're just in the process now of the confirmation of Robert F. Kennedy Jr. to be the Health and Human Services Secretary, which is kind of like the US Health Secretary. I'm sorry, I'm trying to move this light away from my face. There you go. That's better. Oh, no, it's not. Oh, well. RFK Jr. has got some very interesting views about a lot of bits of healthcare, certainly in terms of drug discovery and vaccines. It seemed to us as though there was some question about his nomination. I think after the Senate Finance Committee vote yesterday, he looks closer to getting in than we'd have previously thought. That does mean a lot of the companies which are involved in developing new therapies have got a much more interesting landscape to try and negotiate. And then the last picture here is the symbol with the dollar in it. That is the current logo. I think it's the actual logo of the Department for Government Efficiency, which is this sort of quasi-governmental presidential mandate organization, which is very empowered, it seems, to try and strip cost out of the US government, which really means stripping back a lot of the activities the government undertakes. But it also takes a particular aim at regulation. So regulation is very much in the crosshairs. Now, a lot of regulation, particularly around environment, is there to help the world make the transition to a more sustainable economy. And consequently, a lot of our companies are investing, providing solutions which allow other companies to adhere to that regulation, those mandates. And so stripping it back is a real challenge, not just in terms of the actuality of what's going to happen sustainability-wise, but also for some of these companies. So flipping it around again, obviously, if he's challenging for sustainability, there are sectors he does like. Unfortunately, one is oil and gas. You can see here on the left-hand side. There's a very clear mandate already since his inauguration in some of the moves that he's made to drill, baby, drill, to get more of the US open up for exploration, to reduce the regulations to protect biodiversity and, of course, prevent climate change. He's also a fairly keen advocate of cryptocurrencies, including his own cryptocurrency now. And that, of course, means a lot of capital flowing into that sector, which in itself denies capital to other areas. And of course, there's an environmental footprint to cryptocurrency as well. And then lastly, social media companies, the big tech companies, some potential for those to have their operations regulated in some way. Some of the sort of worst excesses which they've displayed maybe being reined in, that seems to have gone quite a long way away under the second Trump administration. So it's a very profound shift. It touches a lot of sectors that we're interested in, a lot of sectors that we are not, and they will obviously have relative benefit. And already we can see a fairly prompt response from the global finance world in terms of spinning on a sixpence and moving off in a different direction. So here we've got 2 very important net zero alliances from the finance world, the Banking Alliance and also the Asset Managers Initiative, both of them under the Glasgow Financial Alliance for net zero. And even since Trump's election, you can see in the top half of this image, all the US banks stepping away from their net zero banking alliance commitments, in a heartbeat. And on the asset management side, the one that's gone is BlackRock. But of course, the way that listed markets work now, BlackRock is so significant. And in fact, its budgetary contribution to the initiative is so significant that immediately prompted a review. It's worth saying, obviously, as those of us that think finance has an important part to play in the transition are specifically trying to facilitate that for investors who want to be part of that. This is obviously regrettable, and it's very important for us that remain to really make sure we're trying to support the transition as much as possible. Now, the point about that from this point forward is it's got meaningfully more attractive because the sentiment against these stocks that we invest in and impact and sustainability stocks has got so much worse that now is a really attractive entry point or a good time to stay with these strategies. The slides that follow, for those of you that came to the annual investor conference, you'll have seen them before. This is us looking at the sentiment, the valuation multiples on our portfolio over a long-term time period, 10 years, taken against local indices and then rebased to 100. This is price to earnings. And you can see at this point, although we're way below the average for 10 years, we're not yet back to the very base of the start of that period. This is price to book, and there we're way below any level we've been before in the last decade. So really, this is a really interesting time for investors to get into this, because after Trump's election, you could not really think of anything which would put sentiment at a lower point. And from here, we build. Now, what that has meant, though, in the fourth quarter, the historic performance was definitely challenged as a result of the election. You can see here, this is the slide that hopefully you guys are familiar with as we try and explain about what we do and what the factors that impacted are. Cleaner energy and health, key themes for us, both of those struggling very heavily in the quarter. We managed to do a bit better than both of those. Mid-cap growth is one style factor we're exposed to. That was strong this quarter, but a lot of that was kind of US domestic manufacturing mid-cap, particularly some of the stuff in the energy supply chain, and also this idea that we're all benefiting from tax cuts, potentially in deregulation. Then the MSCI world, strong again. Of course, mega cap tech was strong in the quarter as well. And it really does come at the end of a long and difficult period for sustainability after the peaks of 2020. We've talked about this quite a lot. That sentiment just draining away, and this quarter with the second election of Trump really putting the whole project in question, or it seems in question. We don't think it is. We'll come on to that later. But certainly from a sentiment point of view, it's a really interesting time to be an investor. A bit more detail then, what actually happened in the quarter. This is our contribution. You can see thematically down the bottom there, cleaner energy and health, the weakest areas. And then in terms of some of the specific names at the top, environmental services, Smurfit, Westrock, and then resource efficiency, Autodesk. We'll come on to those in a second. And down at the bottom, we'll start with the negative contributors. Icon, contract research organization, we've had to talk about it this quarter and the previous quarter, certainly having a difficult time. It enables pharmaceutical companies and biopharma companies to carry out the trials they need in order to deliver the new therapies they're developing. Clearly, from a sentiment point of view, owning this stock, there's a picture of RFK on the right-hand side, and there's a big question there. On the fundamental side, already their clients are responding to this and making changes. You can see here on the left-hand side of this slide, you've got comments from their quarterly results. They're talking about cancellation of vaccine programs, cuts to large pharma budgets, and caution in the biopharmaceutical market. Now, the vaccine cancellations, it's not nothing in their business. It's not the largest part. So Icon is not a vaccine play per se, although a lot of people would have it in that basket. But these are definitely sort of real issues it's got to contend with. And obviously, as I said, the sentiment is weak. Where its valuation is now, we really like it. We've known this company for ages. It's exceptionally well run. It's got a sort of laser focus on costs. It knows exactly what it's doing. It's benefiting from a long-term outsourcing trend. And so we're still very happy holders here, and certainly the valuation very compelling at the moment. So then second biggest negative contributor, the canary in the coal mine, the sort of flagship, one of the flagship cleaner energy stocks, certainly in the wind space, Vestas, a Danish manufacturer of wind turbines. Clearly the sentiment against clean energy very weak now. If you look about the specifics for them, there's a piece about their margins which are recovering. That's an important part of investing in Vestas. We're not really touching on that today. Look at that order intake on the left-hand side, though. So you've got quarterly order intake, and in light green, I've given you the US number, and the light green line is the percentage. So we're talking sort of 20%. The yellow bars are the sell-side consensus orders through 2025. You can see that it just looks like people are taking all the US orders, including the onshore orders, out of their order book and not saying they're replaced elsewhere. We think that's very bearish. On the right-hand side, a key point in the last quarter is GE Vernova, one of Vestas's key competitors, but it's a US company which also has an interest in fossil energy. They've decided they're going to freeze looking for offshore wind projects altogether. So they've decided they're going to float with the way the wind is going at the moment. That obviously opens up the competitive opportunity of Vestas, and we'll talk about what that opportunity is in a few slides. Lastly, in terms of native contributors, a big holding for us is life sciences tool company Danaher, has been for a long time. It's got some diagnostics business, but also it's really geared into drug discovery and life sciences. Its flagship segment is the biotechnology segment, which was the old GE healthcare business known as Cytiva. It's a very unique and special business. The growth rates of that business have been recovering from a trough and haven't gone fast enough. Really, that's to do with slow growth in China, in addition to the problems in the Western markets. We still have absolute conviction in the long term. That's an interesting story, but after running up a bit into the quarter, it was weak in the quarter itself. Flipping to the positive, Autodesk, computer-aided design software company. It has had an activist investor since the summer, and it has changed. Before the active investor even arrived at Starwood Capital, it was changing its business model, transitioning to a different way of working with its partners to gather its revenue. There was a dip in billings, potentially as a result of that, and also cyclical, but you can see that has recovered very strongly. And actually the positioning of Autodesk now, if we're going into a period where there's sort of stronger US domestic growth, and also the power of artificial intelligence, very important for Autodesk. You can see on the right-hand side a recent CMD they had about digital twins, highlighting the power of artificial intelligence. Digital twins, by the way, for those that don't know, is where you create an item or an object in a virtual environment so you can test and stimulate the impact of the environment on the life of that item and how to design it. It's got a huge saving in terms of resources. It's very interesting sustainability technology, and they've been highlighting their increased ability to do that and just how popular that technology is going to be as it rolls out. So Autodesk is doing very well. And then the last name, we're very pleased, although not surprised. The market was obviously a bit surprised, but we've invested in packaging company Smurfit Kappa, as was for over a decade. It bought Smurfit Westrock. It actually announced that over 18 months ago. It was coy. Smurfit were coy about the scale of the synergies they thought they were going to extract, and they revealed them in the fourth quarter. And the market was pleased and pleased with that. We weren't particularly surprised. We've seen what wonderful operators that organization is. And on top of that, their growth is really about sustainability and making packaging more sustainable, not just recyclable, using recycled materials, but also reducing the use of packaging altogether. So great to be on board as that business expands and starts to take that mission more globally. So then a couple more outlook slides from me before I pass over to Seb. And these are kind of crucial because, I mean, hopefully you've picked up, it is obviously a very challenging time for sustainability and impact. But with those that valuation support, we do think there's a lot to be said for investing now and staying invested or starting a position. First of all, global progress absolutely hasn't stopped. We'll come on to the US in a second. It hasn't stopped there, but it certainly hasn't stopped outside the US. Some examples: Japan, the world's third largest economy, its GX plan for global transition is knocking on 1% of its GDP. It's really a very significant investment. They're just in the right now in the kind of consultation period for their 7th energy strategy plan. You can see on the right-hand side of those 3 bars talking about 45% renewables by 2040, 20% nuclear and 35% fossil. Some people say that's not enough, but the point about Japanese planning is they're always conservative. So you're going to see it go higher than that. I'm absolutely sure of it. And of course, they're very good at delivering this, and they're very technologically advanced, and they're absolutely on board. So that's very important. And then on the right-hand side, speaking to Vestas' opportunity, for example, specifically, last year in Europe, there were 19 gigawatts of offshore wind contracts auctioned. This year, it's going to be more than twice that, 45 gigawatts. Well, even if it doesn't reach 45 gigawatts, now that really in the West, there's only Vestas and Siemens Gamesa bidding for this, Siemens Energy bidding for this, a lot of that potentially is coming Vestas' way. And it's a big number generally. Just to put that in some more context as well, Vestas took in 4.5 gigawatts of offshore last year, 3 gigawatts the year before. The year before that was just getting started. So really, you know, if they keep their share on this, you are talking about quite big numbers now coming through in offshore wind in Europe. So that's obviously a sign of things continuing, notwithstanding the sort of noisy headlines. A little bit on the cycle as well. Important trends for us as sustainability investors around resource efficiency and making industry more carbon efficient. Also industrial semiconductors on the left-hand side, automation growth on the right-hand side. These are growth rates for baskets of companies doing these things, and we're invested in several of them, such as Infineon and Keyence. And you can see that cycle that's fairly common to both of them. It matches purchasing manager indexes, which we've shown you before. Big cycle down after a sort of COVID high, and also to do with Chinese growth normalizing. It does look to us as though the third quarter of 2024 may have been something of a bottom there. How this interacts with confidence after the American election is a question, but there's a cycle to business confidence anyway in the way that destocking works. That means that potentially all of these companies, and we do have quite a lot of exposure here, that cyclical upswing may combine with structural drivers continuing. Switching back to the US very quickly, the Inflation Reduction Act is the big weightlifting US transition policy put in place by the Biden administration. Obviously, Trump wants to take a tilt at as many parts of it as he can, but he will have something to think about because a lot of the beneficiaries of the Inflation Reduction Act are Republican states in the US. On the right-hand side, you can see proportions of renewable energy, coming from renewable sources in different US states. Red ones are Republican, blue ones are Democrats. You can see there's a lot of Republican states already invested there. And consequently, the letter, which actually is from last August, from US Congressman to Trump saying, please be careful about how you think about taking the IRA down. I think it's clear that that's not going to be universally popular. And I guess a flagship for that, of course, is Texas, which, despite being the most sort of Republican state, is also a huge investor and beneficiary from the energy transition and renewable energy. So lots of reasons to be positive in addition to the support from valuation. The last sort of point I would just observe is a mixed one, but still has a positive message as well. We do now move into an era where industrial policy and politics are absolutely front and center. Obviously, as investors, what we kind of prefer is a market where the playing field is relatively level and you can pick the company that performs best and invest in them. Negotiating around government policy is more tricky. But if you look at the pie chart on the left-hand side, a third of the recent policy interventions have been around climate change. There is supportive policy intervention there as well, even if you're also coping with things like the tariffs, which Trump announced last week and then has already rescinded. So the message we want to give here is it will be tricky. You'll have to invest around it. But the license that governments have to really support the transition through industrial policy has never been greater. That makes us seem very old, but there was a time at which over a decade ago when it looked like carbon prices might be introduced and then they weren't. There was a question at that point about what we would do because industrial policy was so out of favor. Industrial policy is definitely back, and it'd be very hard to see in a lot of global markets that wouldn't be a green orientated industrial policy. So again, apologies that we are running over. I will stop my speech now and stop sharing, and I will hand over to Seb.
So thank you very much. I'm going to talk about climate adaptation. It's something that we have addressed at a past webinar, although not for a couple of years. And we think there are some clear reasons why this has become a more important investment thematic for us. So we thought we thought it was timely to revisit it. I don't want to spend too much time focusing on or commenting on the extreme weather that we saw in 2024. It was a pretty consistent story throughout the year. Flash floods in Valencia, hurricanes in the States, our own storms in the UK. And in fact, I heard just this morning that January 2025 was the warmest January on record. And that's remarkable because that happens in the context of a receding El Nino, which would normally be expected to reduce global temperatures, and that hasn't happened, and that's got scientists even more alarmed. The other thing that's been interesting about 2024 is that we've been able to see science has been able to discern a clear footprint, if you like, of climate change on these extreme weather events. So the flash floods that we had in Valencia are twice as likely to occur going forward as previously as a consequence of climate change. Hurricanes Milton and Helene were both significantly more severe in terms of wind speeds, but also brought much more extreme rainfall as a consequence of climate change. And Los Angeles, the fires in Los Angeles were made much more likely because of both excess precipitation last year and then a subsequent drought, which meant there was much more flammable material in and around LA, which made those fires particularly intense. So while these events have been very much in the headlines, very sort of dramatic, there are slower changes which are no less profound. The chart here on the right is taken from an article that was published in the Washington Post a few weeks ago, and it shows you the average sea level at a place called Fort Pulaski in Georgia in the US. And you can see this data goes back to 1940, and you can see how average sea levels have risen every year. Well, not every year, but consistently risen over that period, relatively slowly initially, and then an acceleration since 1980. average sea levels are now 18 inches above where they were in 1940. And this is being replicated to some degree across the whole of the eastern seaboard of the US, and NASA have projected that many cities along the eastern seaboard, including Boston and New York, are likely to see up to 100 more days of high tide flooding every year as a consequence of these higher sea levels. So obviously those headlines are dramatic, compelling, but as investors, we are in a way more interested in what's happening in the underlying economics, as that's ultimately going to be what drives investment decision making. And it is clear that economic losses are growing. In significant part, that's because there are more assets to be damaged, but it's also because of the process of climate change making these events both more frequent and also more extreme. And the most visible impact that we see today is in insurance. So that chart on the left-hand side comes from Munich Re, and you can see how over those 3 periods, so if we look at the last 30 years, average annual loss, economic losses from natural disasters was around $95 billion per year. And then if you look at the last 10 years, that's increased to 240 billion. And then last year it was 320 billion, of which 93% was due to weather-related issues. These are all inflation-adjusted numbers. And then on the right-hand side of that, the chart on the right-hand side, you've got the European numbers that were released just a few days ago. If you go back to the decade from 2010 to 2020, an average annual losses of around 18 billion euros across the EU. And then for the period from 2020 to 23, that jumped to 44.5 billion euros. So a very similar story in Europe as well. But the important thing really about this is it's not just the economic impact on the capital base, the assets that are in the economy, there's also an impact on the yield as well of capital. This comes both from higher costs, so we are seeing higher insurance premiums in areas that are prone to extreme weather. In some places, it's actually impossible to get insurance for these types of events. And of course, if you can't get insurance, then banks aren't going to lend money, they're not going to give mortgages on properties, and that clearly has a very dramatic impact on economic activity in those regions. Productivity can also be hit. There were a couple of companies that were reporting, Indian companies reporting on their recent earnings, a company called Zomato, which is a food delivery service. They were talking about how heat stress has reduced the productivity of their food delivery drivers. And then this quote here from Larsen and Toubro, which is a construction business, in their first quarter earnings. This is an excerpt from their transcript, their earnings transcript. And here they're talking about how extreme heat is reducing the productivity of their construction workers because they're having to shift the times at which they work. They can no longer work in the middle of the day in India. And in fact, some forecasters are suggesting that up to 25% of Indian GDP is at risk over the longer term from climate change. And we're seeing similar effects in Europe as well. The European Central Bank published some data recently that indicated that the heat wave in 2022, which led to crop yields declining, then caused inflation of around 1%, just under 1%, an impact that lasted into 2023. And this is causing financial regulators like the FCA here in the UK and also BaFin, the German regulator, to take a much sharper look at the likely effect of climate on asset prices and risk. And there was a very interesting op-ed in the Financial Times at the end of last year, where the author was speculating that a material proportion, in his view, of monetary policy committee meetings would be taken up in future with discussions on how economic forecasting is likely to interact with expectations of extreme weather. And just as a little anecdote, because I thought it was quite interesting, there is a weather vane on the roof of the Bank of England still today, which is connected to the main conference room in the bank with an indicator showing where the wind is coming from. And that's because it used to be very important to the Court of the Bank of England to know which way the wind was blowing, because the number of ships docking in the Port of London would affect commodity pricing on the market. And the author of the piece was sort of indicating that this is a return. The current focus on meteorology has turned to the importance of weather and climate in central banking. So just a sort of interesting historical anecdote there. But I think it is clear that the financial systems are beginning to respond to climate change, whether this is through the insurance markets or through regulation. And as a consequence, we're interested in understanding how we might invest in the companies that are providing the solutions to some of those issues. So at WHEB, for many years, we have, of course, been investing in companies that help mitigate climate change. That is, companies that sell products and services that help reduce emissions that cause climate change. So businesses like sustainable transport businesses, clean energy businesses, energy efficiency businesses, and so on. But a couple of years ago, we also introduced an investment thematic focusing on adaptation, and that is companies that sell products and services that help to manage the risks of climate change impacts. And there are, of course, some areas of overlap between mitigation and adaptation. So, for example, home energy systems help to reduce emissions through the use of solar panels on your roof or more efficient heating systems. They also help to make buildings more resilient by providing energy storage as well. So there is some overlap in the middle there. And we think that adaptation is a particularly interesting investment thematic at the moment for a number of reasons. Firstly, because, as I hope I've shown, the climate science and indeed our lived experience clearly indicates that there is a growing need to adapt to climate change. Secondly, it also, if you like, acts as a kind of natural hedge to inadequate mitigation. So if we don't reduce emissions sufficiently, that will lead to additional requirements to invest in adaptation. It's also less politically contentious, I think, than mitigation. Political support for efforts to reduce flooding risk, for example, are generally less contentious than efforts to reduce emissions. And it's also much less prevalent as an investment theme. So there's perhaps more of an opportunity to find underpriced assets in adaptation than there is in mitigation, which is already a relatively common theme across the market. And then finally, I think it probably is worth just restating that adaptation is not a substitute for mitigation. If we don't reduce emissions, then eventually the adaptation bill will become unaffordable. So we do need to do both. So just finally, in terms of how we invest in adaptation at WHEB, we are already seeing evidence of spending on adaptation technologies in our portfolio. So Advanced Drainage Systems, which is a manufacturer of storm water management systems in the US, they have delivered 11% compound annual growth rate in their revenues over the last 5 years. Some of this has come from acquisitions, but the majority, as they pointed out in a recent earnings call, is coming from clients who are keen to adapt to more extreme weather in the US. A similar story at Arcadis as well, which is a Dutch engineering business. They recently reported organic growth in the high single digits, and again, underlined the importance of clients demanding support in terms of their own climate adaptation efforts. And then there are also a variety of other businesses across the portfolio for whom adaptation is also an important source of revenue. Xylem and Veralto in our water management theme supply products and services that are aimed at helping clients reduce the amount of water that they use and also to reuse more of the wastewater that they already have. Train Technologies has a business in energy storage for commercial buildings, and MSA Safety, whose main business is in supplying firefighters with equipment, mainly for buildings, fighting fires in buildings. They do also have a business supplying firefighters operating in rural areas as well, such as the ones that we saw in and around Los Angeles. So I hope that's helpful. Thank you very much, everybody.
Thank you.